If I buy a house as an investment, I can either A, sit on it and just wait and hope for the value to go up, or B, I can be a bit more productive by renting it out and have someone else pay for the mortgage while I sit and wait for the value to go up. Or C, I can take action by fixing up the house now, maybe adding an extra room, a bathroom, or a pool to force the value to go up. Those are my three options. Now, if I buy stocks as an investment, there's nothing I can legally do to force the value to go up, so C is out. But the average investor seems to only know how to buy and hold and may not know that there's actually an option, no pun intended, where I can collect those quote unquote rent to generate cash flow while I hold a stock, which is what I like to do. So let's go over one of my staple investment strategies, the covered call. Reminder as always, this is not financial advice. This is for educational purposes only. So first, I need to know what a call option is. Just like how I can buy and sell stocks, I can just as easy buy and sell call options. So a call option is a contract that gives the right to buy a stock at an agreed price. And in this contract, there's two parties. We have a buyer of this contract and a seller of this contract. And just like any other contract, it has an expiration date. Easy way to think about this is similar to how insurance works. As a buyer of an insurance contract, I'm paying a premium to the seller so that I have that option to cover my ass in case something happens. And as a seller of insurance, I'll have an obligation to deliver and cover the buyer's ass as promised in the contract. But if there's no accidents and the contract expires, the seller is no longer obligated to cover that ass and gets to pocket that premium. So if buying a call option means I'll be paying a premium to have the right to buy a stock at an agreed price, that means as a seller of this call, I'll be getting paid a premium for promising to sell a stock at the agreed price. But if the contract expires worthless, the contract is no longer valid and the seller pockets the premium. How does a call option expire worthless? Well, let's say JRY is currently trading at $50 and I sell a call option at an agreed price of $55. This is known as the strike price in this contract, and I make it good for the next 30 days. That means I'm promising to sell JRY stock to the buyer at $55. So if the price stays below that in the next 30 days, let's say it's trading at $52 now, well, the buyer who I shook hands with in this deal, given that everything is right in their head, isn't exercising this contract to buy it from me at the agreed price of $55 when anybody and everybody can go out in the open market right now and buy it for much cheaper at its current price of $52. So the contract would expire worthless, it disappears like a fart in the wind, and I walk away with the premium. Only if the stock price is trading above the agreed strike price is when I'll have to honor our agreement. So let's say instead 30 days from now, it's trading at $60. Well, shoot, now I'll have to go out and buy JRY at its current price at $60 and turn around and sell it to the buyer at the agreed price of $55 as promised and losing the difference. Seems pretty risky. But that's if I sold a call option on its own, also known as a naked call. In a covered call, I'm still selling the same call to collect the premium, but it's going to be on a stock that I already own, which is where the term covered call comes from. I already have the shares to deliver. If I have to keep my promise, I have it covered. So let's take a step back. Same scenario. JRY is currently trading at $50, but here I already own 100 shares of JRY from, let's say, $45. Great, I'm up $5 per share, but I feel like we may get a short-term correction, whether we're into resistance or had a huge rally up on volume or both, whatever the analysis is, I'm not expecting this to run up another $5 or 10% in the next 30 days. Well, instead of just sitting on the house and watching the price stall or pull back, what if I can bring in a renter to collect a premium and generate some income in the meantime? So I sell a call promising to sell this stock, let's stick with the same strike price at $55 and collect a premium of $2 for making that promise. And in the next 30 days, if the stock does what I was expecting and stays below $55 and pulls back to $48, well, I just offset that $2 drop by bringing in that $2 premium. And if the price keeps going up to, let's say, $52, okay, great. That contract still expires worthless and I still pocket that $2 premium and I still benefit off of the gain on my stock position. Only when it blows the roof off is when I'll be forced to sell my stock at $55. Well, damn, you mean to tell me I have to sell my stock for a profit of $10 per share and get paid a premium to do it? How will I live with myself? So if I do the math, this actually works out the same as selling at $57 because I collected the $2 premium. Or I can also say I reduced my cost basis on my position from 45 to 43 bucks per share by collecting that $2 premium. However I want to look at it. So the worst thing that can happen in a covered call is having to sell my stock position for a profit. And the beauty about the stock market is that it's a very liquid market. I can get right back in, get my shares back if I really wanted to. Now, wait a minute. What about the risk of the stock crashing and going to zero? Isn't that the worst thing that can happen? Well, if this is a stock I was going to buy anyway, if these are positions I have in my IRA accounts, that's a risk I already have by owning the stock on its own and would have to manage it anyway. But by adding a covered call, this actually eliminates some of that risk because I'm collecting premiums, which reduces my cost basis over time on these buy and holds. And who knows, if I collect enough, let's say I bring in this $2 premium every month for the next 2 years, well, this stock just got paid off. It can go to zero and I would still break even on it since it would be a free position for me versus owning the stock and doing nothing but just holding and hoping. So it's about being more proactive than reactive. So the next question is, how do I decide which calls to sell? So here's an options chain. Here's where I can see all the options contract out there that I can buy and sell. So first I need to choose an expiration date. Generally for this strategy, I like to stick to a 15 to 30 day time frame. Rarely do I go beyond the 40s. Of course, the more time I sell means the more premium I can collect, but generally I like to stick to 15 to 30 days. So if I open up the 30-day contracts, I get a list of all the options with 30 days till expiration. And the first thing I like to look at is the delta column. If I wasn't familiar with option Greeks, I have a beginner video on it, which I'll link on the screen. And the strike prices I like to check out are the ones between a 15 to 30 delta. Think of delta as a very rough probability that this call I sell will have to be exercised. So in other words, there's a 13 to 34% chance this stock may hit these price levels. Or I can look at it as about a 70 to 85% chance that it won't and it will expire worthless and I'll get to pocket that premium, which is how these premiums are priced in. They have all these fancy computers that do all the math on how the stock has been moving and behaving, and it calculates all the moving parts to give us these numbers and prices. So pretty simple, 15 to 30 day expiration and a 15 to 30 delta. And I like these range of numbers, not because it's easy to remember, but anything below 15, yes, the probability of this expiring is much higher since it'll be at a much higher strike price. And also there's less time involved, so faster expiration, which is also an advantage for me as a seller. But normally the premiums below these levels are just too little and tend to feel like I'm working for crumbs. And anything above 30, the premiums get much juicier and look more tempting, but also the probability of my stock getting called out is more likely. So I found this to be a good sweet spot to work with for me. Again, this is not advice or a recommendation. This is just what I like to work with. So now that I narrowed it down to a few, I look at the chart, look at my choices, and see which fits best together. So this stock's current price is at $54.20, and let's say I own 100 shares of it. Now, a few things to remember. Option contracts work in the increments of 100. So one call option equals to 100 shares. So if I have an odd number, like 73 shares of the stock, and I sell one call on it, it won't be fully covered, meaning I would need to go out and buy another 27 shares to deliver if needed. So it's cleanest to sell calls on positions that I have in increments of 100. So here I'm siding more towards the conservative side because I see they have earnings coming up in less than a week. Price seems to be moving up in a controlled manner. It's not extended, but it's also up over 50% since the last earnings date. So the strike price I'm eyeing at 65, that would be another 20% gain on the stock. So if I do have to end up keeping my promise to sell at those gains, I'm not complaining too much. Also, the bid-ask spread on it is much tighter than the rest, so I always like to check the open interest and volume on it as well. I like to see at least in the hundreds for the open interest. That would mean it's liquid enough. So this I can definitely work with. So if I split the bid-ask spread here, I can try to squeeze 158 out of it. But if I wanted to make sure I get filled, I can be nice and do 155. So if I'm collecting $1.55 per share off this stock price of $54.20, that comes out to almost a 3% return. Meaning if I did that 12 times a year, every 30 days, that's over a 34% return. I really like those numbers. Anything close to 2% is what I would consider a good return on these premiums. Okay, so now that I sold one call, collected a buck 55 or $155 on my 100 shares, here's how I would manage it. So let's build out a little tree here. First, let's look at if the price drops. That brings the call even further out of the money, and the chances of this hitting 65 has decreased even more. So I can probably buy that call back for much cheaper to lock in some profit. Or my other choice is to continue to sit on it and see if it expires worthless to try and collect the full amount of a buck 55. So how I decide is I'll weigh how much time I have left on this contract and how much of the premium I'm able to lock in. So for example, if the price has a nasty pullback this week and I can buy back the call for pennies, well, it's not the best to try and hold out to make the extra few cents when there's still 3 weeks left in the contract. It'd be more lucrative for me to use that time better by closing out this contract now and selling another one that can maybe bring in another buck 55. So this is like bringing in a new renter with fresh new rent. Or if I didn't want to be in this stock anymore, if it's hitting my stop loss on my stock position, well, I just help offset some of that loss by the premium I brought in. But if it's a steady pullback, I usually lean towards closing and selling a new one. And if I want it to sound like I know what I'm doing, that's called rolling down and rolling out on my call. I'm rolling down in strike price, so I close it and sell a new one at a lower strike price. And I roll out in time, so I reset the clock and sell a fresh new 30 days again to collect another buck 55. So I'll do a little bit of math, weighing both sides and asking myself, how much time do I have left and how much of the premium am I still trying to squeeze out, and go from there. Scenario number 2 is what if the price goes sideways? Here, I would probably just let time work in my favor. Each day that passes, including weekends and holidays, which is nice, I'm making money on my premium, even if I'm not making any gains on my stock position. But of course, I do also have the option to close and sell a new one. In this case, I would only look to roll out in time and not roll down in price, since we're still trading around the same price levels and wanted to collect a similar premium. So here I would use the same strike price, but push out the expiration date depending if the juice is worth the squeeze. And finally, scenario number 3 is what if the price goes up? Well, I always have the choice to let it expire if it's staying below that strike price. But if I really don't want to get called out at 65, I can roll up in strike price and or roll out in time. So I'll have a gain on my stock position, but the call I sold is getting more expensive to buy back as it's getting closer to the strike price. So I'll have to buy it back at a partial loss. Let's say I have to buy it back for $2.55. So I'll lose $1 on it. But guess what? I can turn around and sell a new one at a higher strike price at, let's say, $70 now, roll out in time, reset the clock, and possibly bring in another buck 55, which at the end of the day will still net me 55 cents to promise to sell at 70 now, which I now may be okay with letting go at that price level. Or if the price ends up blowing the roof off, well, that's unfortunate because there's not a whole lot I can do but let it get exercised. This is why I said the worst thing that can happen to adding the covered call strategy is if the stock explodes. I'm giving up all of this upside to collect these premiums. But you know what? If the price drops hard, I'm mitigating my loss. If price drops a little, I'm offsetting it and reducing my cost basis. If the price stalls, I'm still making money, I'm collecting income. And if the price moves up a bit, I benefit on both the stock and I keep the premium. And if the price explodes, I still get paid to sell at a profit. And if I really wanted to, I can get back in at any time. So the only time I wouldn't do this is if I'm always choosing stocks that have an explosive move up like this. Which if I am, I'm probably not watching this video anyway. But think about if I had 10 of these going on, especially if they also pay dividends. That's a nice little cash flow every month that I can continue to buy shares with. So it's not the sexiest strategy. I'm not getting rich overnight doing this. It's about getting those base hits over time that grows my account. And at the end, it turns out to be pretty sexy. Hope this was useful. See you on the next one.